Alright, hey guys, Scott here again with a brand new video, and so in this one, we're going to run a few different back tests using this Option Alpha platform here, and you're going to see very clearly that using stop losses when you are selling put options in many cases will actually reduce your performance and your profitability in the long term. Now with that being said, of course there are caveats and exceptions to that general statement, as you will also see in this video, but even in the cases where stop losses do help reducing your losses in the long term, as you will also see, the impact overall is very, very minimal. Now briefly here before we dive in though, if you guys also want to run these same kinds of back tests yourself and also automate your specific option trading strategy, then make sure you watch until the end of the video. And then also, if you want to join a very exclusive online community where you can learn how to trade options and my overall approach to the markets, then you can now join my options trading Discord as well. So definitely check out the description of the video below to learn a lot more about that. And then lastly here, for anybody who is also brand new to the channel, again, my name is Scott, and you can also find me on SKILLSHARE as well, where you can take my very detailed classes on options trading or stock market investing. And you will also find some links to a few of my introductory courses in the description of this video as well. So be sure to check them out, and when you join SKILLSHARE using those links, you'll get a full 1-month free trial. Alright guys, so now we'll dive in here, and so for the first set of back tests we're going to run, we're going to use SPY, or basically the major ETF that tracks the S&P 500. And so real quick, we'll go to the top right corner here and click on New Backtest. Now, as you're going to see here, all the back tests we're going to run in this video are going to be identical with the exception of two main variables. Number one, the underlying symbol or the underlying asset basically, and then number two, the stop loss parameter as well. So like I said, the first set of back tests we're going to do are going to be on SPY, and one back test is going to not use a stop loss at all, but the second one is going to use a stop loss. But besides that, all the rest of the parameters here are going to be the same. So first off with the symbol, like I said, we're going to go with SPY. And then for the capital allocation, we'll click on this and we'll say for our starting amount, we're going to begin with $250,000. And then for each trade allocation, we're going to say that at most for every trade that we're going to make, we're going to allocate no more than 5% of our total capital for that one position. Right, so you can see that here, 5% of capital per position, and then a maximum amount of, we'll say 30%. Right, so basically amongst all the trades together that have been made during this backtesting period, at most we're going to use 30% of our capital, which if we divide 30 by 5, we get 6, right? 6 times 5% is 30%, so ultimately that means we're going to have at most 6 different positions on at the same time. And then the remaining 70% of our capital is just going to sit in cash. So that looks good. Go to save and then save again. Now for the duration of our back test, we're going to use 10 years for all the back tests we're going to do here. And then moving on to the trade frequencies. So we're going to stick with once per week. The simulation here is going to go ahead and make a new trade. Unless of course we've already met our maximum threshold for our max allocation. Right, so if we're already using 30% of our capital, then it's not going to go ahead and make a new trade for that particular week. And then for the strategy here, we're going to go with a short put spread here. Unfortunately, Option Alpha does not yet support a simple naked put option, but as you're going to see here, we can very easily simulate a naked option with a credit spread as well. And then expiration will say that most of the trades are going to have about 30 days until expiration. That's fine. And so now down here, because credit spreads involve two different options, one short option and one long option, this is how we can construct a credit spread that behaves a lot like a naked option. So for the short leg or the short delta, we're going to choose a 50 delta, which basically means that the strike of the short option is going to be basically right at the money. So the strike price and the actual stock price of SPY are going to be about the same. And then for the long delta or the long contract, we'll make this only a 5 delta. So this one is going to be super, super far out of the money, almost worthless essentially. And so that's why this overall put credit spread is still going to behave just like a simple naked put option. And so besides that, that's pretty much it. We're not going to use any IV rank filters, no profit taking, no exiting the position based on days until expiration. And for this first back test, no stop loss either. So finally, I'll click on Run Backtest and we'll see what happens. All right, guys, here we go. These are the final results. And so first off, we'll begin by looking at the chart here, which shows you the portfolio's value across time. Again, starting from 10 years prior, back in September of 2012. And for the most part, as you can see here, there has been a pretty steady rise in this portfolio's value, which makes sense because selling put options is a bullish strategy. And for the most part, over the long term, the market does climb higher. Now, of course, obviously right now we are in a bear market, so this portfolio's value has dropped somewhat significantly, but still overall, it looks like we've made about $475,000. That's pretty darn good. And then if we come down here and take a look at the more detailed statistics, we can see the max drawdown during this 10-year testing period was down by about 22%. That's not too bad, especially when you consider the fact that during the COVID crash of 2020, the market dropped by over 35%, right? And then like you saw on the charts, the overall final P&L was plus about $475,000, which equates to almost a 200% return on the beginning amount of capital, right? Of $250,000. So this is pretty decent. And then coming down here, as you can see, we've had over 500 different trades over the course of this 10 years, and we had an overall win rate of just shy of 80%. So 400 of those trades were wins, only about 100 were losses. And you can see the worst of those losses on one trade was minus $38,000. So definitely a pretty sizable drawdown, but again, overall, this portfolio made a decent amount of money. And again, keep in mind, no stop losses were used at all on any of these trades, right? So even during some of the worst crashes and dips and bear markets here, not using stop losses at all still yielded a very, very nice profit. But now what about the case of actually using stop losses in this exact same kind of backtest here? So again, I'm going to run this backtest once more on SPY. All the parameters will be the same, except we're going to use a stop loss on all the trades. All right, guys, so here we go. I've gone ahead and created a brand new backtest. Again, all the exact same parameters as before, except now the stop loss configuration, we'll set that to, let's say, 200%. Right, so basically what this means is, let's say, for example, we sell a put credit spread for $500 in premium or in starting credit. So then a stop loss of 200% means that if the losses ever get to a point where they're 200% of that beginning credit, so in this case, with using $500 in our example as our credit, then 200% of that would be $1,000. So again, bottom line, if the losses exceed $1,000 on that particular trade, then the software here is going to go ahead and cut those losses and simply exit the position. And so, of course, in some cases, cutting losses early might actually be beneficial, right? Because otherwise they may have gotten worse after that point. But other times, by cutting losses, that's going to make things even worse, right? Because in other situations, the trade may actually come back around eventually and be a smaller loss or perhaps even a profit. But by cutting losses and simply getting out, you're never going to know the final outcome. And so with that in mind, we'll go ahead and run this back test and see what happens here. All right, guys, so here we go. These are the final results. So once again, we'll come down here and take a look at the chart first. So as you can see, a pretty similar looking chart as with the previous back test where we did not use a stop loss at all. So once more, we have a pretty steadily rising portfolio value across time, of course, with the exception of a few dips and crashes along the way. But overall, still using stop losses when selling put options can and will still make you money in the long term. But that being said, if we come down here and take a look at the more detailed stats on this particular back test, as you can see here, the overall P&L was about $100,000, actually a bit more, less than the previous back test, right? So again, if we go back to that previous test in this other tab here, as you can see, the final P&L for that test was $474,000, a lot more. But perhaps these smaller profits could be worth it if the overall max drawdown with using stop losses and perhaps the worst loss on any one trade, if those metrics are much smaller, then perhaps using stop losses might still be worth it. So again, back to the new back test with stop losses, right? The max drawdown was actually a bit worse, right? So in the worst case, you lost 23.8% of your account, whereas in the previous back test, you lost only 22% of your account. So using stop losses did not improve your max drawdown at all. In fact, they made it worse. But one area where things did improve was the worst loss across all those trades. right? So across the 10 years of testing, we had 512 different trades, and the worst loss amongst all of them was about $23,500. And this is compared to the worst loss being about almost $39,000 with not using stop losses at all, which I think makes sense, right? So of course, if you're going to use stop losses, then on a per trade basis, your worst loss is going to be smaller. But still overall, right, when you factor in your final profit at the end of this 10-year period and you factor in your max drawdown as well, both of these metrics, which are very, very important, were both worse when you were using stop losses compared to when you were not using stop losses. So ultimately, that's why if you are selling put options on more stable products like ETFs in this case, or more blue chip companies like Apple, Google, Microsoft, etc., assets with minimal volatility and that do tend to climb higher over a long period of time, in those cases, using stop losses clearly does not improve things at all. Now, that being said, like I mentioned earlier, right, of course, there's going to be exceptions and caveats to that general statement. So again, on more stable underlyings like SPY, ETFs, blue chip companies, using stop losses might make things worse. But on very risky underlyings, individual stocks that are highly volatile, that's where using stop losses can actually be somewhat beneficial. And so now that brings me to this new backtest, which again has all the exact same parameters, same starting capital, same position and risk allocation, same kind of strategy, deltas, everything's the same, except now the underlying asset is ROKU. And so real quick, if we come over here to Thinkorswim, this is a 3-year weekly chart showing ROKU price action, and clearly this stock is much more volatile and chaotic than SPY. So as you can see, we had a massive run up in price all the way to almost $500 per share. And then everything collapsed and is now still collapsing in this current bear market environment. And so with that in mind, if we come back to our backtest here, and this one does not use a stop loss at all, right? So this one here is going to be our baseline to compare what the impact of using stop losses is in the next backtest. And so down below with the results, as you can see, in the end, things did not end well. Overall, you lost about $77,000. And clearly across all 10 years here, things were very volatile and chaotic. Sometimes you were up huge in profits and sometimes you were down very huge in losses. So finally down below, we can see the final overall P&L was again minus $77,000. Overall return on capital minus 31%, not very good. And the max drawdown during this 10-year period was minus almost 60%. And then across the 248 trades that were made, the worst loss among them was about $19,000. So finally, with that in mind, we'll come over to this tab now, which again is the exact same configuration for ROKU, but this time we used a 200% stop loss. And so once again, looking at the chart here, very similar, but the final outcome was a loss, but still a slightly smaller loss. Right, so down below you can see the final P&L was minus 71,000 compared to, I believe, 77,000, right? So using stop losses saved you $6,000, which is not too bad, but overall compared to a starting capital amount of $250,000, saving $6,000 is a very small amount. And then next up we have our max drawdown was 54.7%, which is a bit smaller than the previous test, right? Without stop losses, the max drawdown was about 59, almost 60%. So again, this is a bit better, but not by much. And then also your worst loss was minus $17,000. Also a bit better than the previous test. And then finally, one more thing is the overall win rate. In this case, it was 60.1%. And comparing this to no stop losses, I believe the win rate was actually a bit higher, 60.5%. So basically, the only benefit that stop losses provided you in this case was a slightly smaller max drawdown and a slightly smaller worse loss on your individual trades. Right, again, back to the stop loss test here, both of these metrics were a little bit better. And then, also, of course, your overall P&L was a bit better as well. But ultimately here, it's pretty obvious that even on a very volatile stock like ROKU, using stop losses on your put credit spreads or your short naked put options, that does not really provide much benefit at all. And again, in most cases, if you're going to use this strategy on more reliable and stable assets, which you probably should, as you saw with SPY, stop losses make things a lot worse. So bottom line here, the decision to use stop losses or not is totally up to you, but at minimum, I wanted to present this information to you guys, all this data basically, so that way you can make the most informed decisions as possible. And so with that being said here, that's going to do it for this video. But of course, one last thing, if you guys also want to run these same backtests yourself, in addition to being able to automate your specific option trading strategy, then join Option Alpha today for a free 30-day trial. And so this powerful and very easy to use software allows you to rapidly configure trading bots that will execute your exact trading strategy automatically, right? So it's the perfect way to eliminate human error and emotion from your trading while also ensuring that your portfolio is always being actively monitored and managed while the market is open. And as you saw in this video, you can also use Option Alpha's powerful backtesting software to improve your strategy by continuously testing and refining your approach over decades of stock market data. And finally, the Option Alpha platform offers a huge online community where you can engage in discussion with other traders, get answers to all of your questions, and find inspiration for new trades and strategies. And so if that sounds good to you, then again, use my link in the description of this video below to sign up and begin your 30-day free trial. And also don't forget to check out and join my options trading Discord as well as my SKILLSHARE courses. Links also in the video description. And finally here, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week and you don't want to miss out. So thanks again for watching, and I'll see you next time.